Today we'll discuss question number 9. From the following, prepare cash flow statement of XYZ Limited for the year 2002. Balance sheet is given as well as income statement is given. Paid up capital, as we know, share capital, it comes under financing activity. Retained earnings, the difference of 2002 and 2001 is treated as current year profit. Long term debt comes under financing activity. Notes payable and accounts payable, current liabilities. Fixed asset, gross and net is given. So for this problem, consider net fixed asset. Net fixed asset of 2001 is 9 lakh, 2002 is 9 lakh 50,000. Inventory is given, comes under current asset. Accounts receivable, current asset. Opening balance of cash, closing balance of cash is given. This is regarding balance sheet. And in income statement, sales is given, cost of goods sold, gross profit, selling and administration expenses is given. EBIT, profit before interest and tax. Interest expenses, so here interest expenses is finance cost, it is non-operating expenses. Interest expenses, it is finance cost, comes under financial activity, and it is non-operating expenses. So in operating expenses, this non-operating expenses should be added. And taxes paid 1 lakh is given, so it is provision for tax as well as tax paid. Income tax current year provision is 1 lakh, so it is assumed that 1 lakh is being paid. And additional information, dividend paid 35,000 is given. Dividend paid, it comes under financial activity, and dividend paid should be added to profit to identify profit before tax. Additions to retained earnings 65,000. So additions to retained earnings, it is just information. We can see here 2002 retained earning is 4,15,000 and 2001 retained earning is 3 lakh. The difference is 65,000. So it is just information. 65,000 rupees is net profit of the year. Depreciation 75,000 is given. So here fixed asset, accumulated depreciation is given, and net balance is also given. So we can solve this problem in two ways. Number one, we can create accumulated depreciation account, or net balance is given here, we can ignore the accumulated depreciation account. So just we'll prepare fixed asset account. I have taken format. As you know, cash flow statement is divided into three parts. Part A, cash from operating activity. Part B, cash from investment activity. And part C, cash from financing activity. And fixed asset account I have prepared ledger format of fixed asset account. First we'll solve balance sheet. Paid up capital, there is no change in paid up capital. Opening balance 50,000, closing balance is also 50,000. Retained earnings, the difference is 65,000. 65,000 is net profit. So 4,15,000 minus 3,50,000. 4,15,000 minus 3,50,000. 65,000. 65,000 is nothing but profit. So net profit 65,000 means 4,15,000 minus 3,50,000. Long term debt comes under financing activity, 5 lakh in 2001, and in 2002 it is 5,50,000, increase of 50,000. So it means long term debt increased. It indicates inflow of 50,000. Company borrowed 50,000 more loan. So it comes under financing activity. Financing activity, borrowing of long-term debt. Borrowing of long-term debt, amount 50,000. Notes payable, current liability increased. If current liability increased, it should be added in operating activity. Increase in current liability should be added. Notes payable increased. Notes payable increased by 20,000. Accounts payable also increased. Accounts payable 80,000 has become 90,000. Accounts payable increased, should be added. Current liability increased. Accounts payable increased by 10,000. This is regarding liability. Next, asset side. Take net fixed asset. Opening balance 9 lakh, closing balance 9,50,000. Fixed asset. Asset will have debit balance, opening balance brought down on debit side. 2. Balance brought down, opening balance 9 lakh, closing balance 9,50,000 by balance carried down, it is 9,50,000. Next, inventory current asset. 1 lakh has become 1,10,000. Current asset increased, it should be deducted in operating activity. Increase in current asset should be deducted. Inventory increased by 10,000. Next, accounts receivable 50,000 has become 60,000. Again, current asset increased. Account receivable increased by 10,000. Next, cash opening balance 10,000, closing balance 85,000. To net increase or decrease in cash, we should add opening balance. Opening balance is 10,000. Closing balance, final answer will be 85,000. Asset part is cleared. Next, in income statement, sales, cost of goods sold, gross profit, selling, general and administration expenses, EBIT, interest 50,000. Interest paid. Interest paid, it is financing, it comes under financing activity. Number 2, it is not operating expenses. So non-operating expenses should be added. It is finance cost. Interest paid is finance cost and it is non-operating expenses, so it should be added. Interest paid is 50,000. And number 2, it is finance cost and it is outflow of cash. It comes under financing activity. Interest paid. Interest paid 50,000, outflow of cash. Outflow should be written in negative. EBT, okay. Income tax 1 lakh. Provision for tax should be added to net profit to identify net profit before tax. Provision for income tax. Income tax is 1 lakh. Number 2, here how much amount of tax paid is not given in additional information. So we should assume entire 1 lakh rupees is being paid. So income tax paid should be deducted at last in operating activity. So income tax paid should be deducted. It is 1 lakh rupees. Income tax paid will be 1 lakh rupees. We should assume that entire 1 lakh rupees is being paid. Okay, here interest paid we have added in operating activity and shown as financing expenses, financing activity, and income tax provision 1 lakh rupees is added here and 1 lakh rupees is deducted here. This information, dividend paid, appropriation of profit. So dividend paid should be added to net profit to identify net profit before tax. Add dividend paid. Dividend paid is 35,000 and dividend paid, it is financial expenses. It comes under financing activity. Dividend paid 35,000 should be shown as outflow of cash 35,000. Dividend paid, it appears two side. Number 1, it should be added to net profit to identify profit before tax. Number 2, as it is financial activity, financing expenses, it should be deducted in financial activity. Addition to retained earnings, it's being taken. Depreciation 75,000. Depreciation non-cash expenses. Number 1, it should be added here. Non-cash non-operating expenses. In operating activity it should be added. Depreciation. So amount of depreciation is 75,000. Depreciation is 75,000. Number 2, we have prepared fixed asset account. Depreciation should be credited. Depreciation debit, asset account credit by depreciation 75,000. Depreciation is 75,000. All the additional information is being finished. So now first close ledger account, fixed asset. We have prepared fixed asset ledger account. First close fixed asset ledger account. Credit side is more. So 9,50,000 plus 75,000. 9,50,000 plus 75,000. 10,25,000. 10,25,000. Take same balance here. 10,25,000. 10,25,000 minus 9 lakh. Balance is 1,25,000. 1,25,000 to bank. So the difference should be treated as purchase of fixed asset. Purchase of fixed asset. So 1,25,000 worth fixed asset is being purchased during the year. So 1,25,000 should be added to investment activity. Purchase of fixed asset. So 1,25,000. So it is outflow of cash. Okay. Fixed asset is being closed. Now close the ledger. So cash flow statement. Net profit 65,000. Add 1,35,000. Income tax plus dividend paid 1,35,000. Two lakh is net profit before tax. And to this 2 lakh add 1,25,000. So it will become 3,25,000. Non-operating income, nothing. So net profit before working capital changes, 3,25,000. And to this add 30,000. 3,25,000 plus 30,000, 3,55,000. And to this deduct 20,000. 3,55,000 minus 20,000, it is 3,35,000. 3,35,000 minus 1 lakh, 2,35,000. So it is net cash from operating activity, 2,35,000 positive balance. Part A. Part B total is negative 1,25,000. 1,25,000. Next, part C total. Part C total will be plus 50,000 minus 50,000, 0. 0 minus 35,000, it is minus 35,000. Part C total is minus 35,000. Net increase or decrease in cash. Part A total plus part B total plus part C total. Part A total is 2,35,000, positive 2,35,000. Part B total is minus 1,25,000. Part C total is minus 35,000. Minus 35,000. So net increase or decrease in cash will be 75,000. A plus B plus C, 75,000. Positive 75,000. Add opening balance of cash 10,000. So closing balance of cash will be 85,000. So this is explanation of problem 9.